Taxes can be confusing, but a basic understanding of the difference between taxes owed and tax withholding can go a long way toward eliminating surprise tax bills and providing more cash flow throughout the year. My name is Mike Heatwall, and I am the founder and CEO of the Dala Group, a wealth management firm focused on helping retirees. In this video, we will dive into an essential topic that can sometimes be confusing: the difference between taxes owed and tax withholding. So let's get started. First, let's discuss tax withholding. Tax withholding is the amount of money your employer takes from your paycheck every pay period to cover your estimated income taxes. Tax withholding may also occur when a financial institution takes money out of a retirement account distribution, or a government agency, such as Social Security, takes money out of your monthly benefit payments. This money is then sent directly to the IRS, and in some cases, your state tax authority. Think of tax withholding as a way to pay your taxes gradually throughout the year. The goal is to withhold the right amount so you neither owe a huge amount nor get a massive refund when you file your tax return. Your total withholding from your employer is provided on your W-2 form at the end of the year, whereas withholding from a government agency or financial institution will be reported on a 1099 form. Now, let's switch gears to discuss taxes owed. Taxes owed are the total taxes you must pay for the year. This is determined when you file your annual tax return. When you file your tax return, you calculate your total tax liability, which is the amount of tax you should have paid based on your income, deductions, credits, and other factors. Then, you compare that to the total amount withheld throughout the year. You will get a refund if your total tax withholding is more than your tax liability. But if your withholding is less than your tax liability, you will owe money when you file your tax return. Let me give you an example of when we often see withholding questions. When individuals are in a sales role, being paid a salary with a significant bonus or commission, the company must withhold 22% on the bonus check, which is typically a higher percentage than they withhold on salary income. We will see questions like, why do I pay more taxes on my bonus checks than on my salary? I feel like I'm working so hard and giving it all to the government. The truth is that both your income and bonuses are taxed the same, but companies must withhold more taxes on the bonus and commission payments. Let's look at two sample tax returns to ensure this makes sense. The first example is of a single retiree no longer working, and the second is of a couple who are both full-time employees. So the first example we're going to look at is of a retiree, and this is her 1040, and this is a retiree that had too much withheld in taxes, and so she's going to get a large refund. So let's look at that as an example to start with, and I'll show you what we're looking for on the tax return. So what you'll notice is for a retiree, you're not going to see anything in the 1A through 1H on the 1040. And then you will see some information in terms of taxable income from 2 to 6, because that's your investment income and your Social Security income. We're going to skip the rest of this here for today's example, though. So what we're looking at is the taxable income is $67,000. So if we go to page 2 of the 1040, that leaves us with tax owed of about $82.88. And once I add in a few other credits and deductions here, we get down to $82.45 is the total tax that she owes for the year. Now again, that's line 24. Now what we want to do is compare that to the total that she had withheld in taxes, as well as any estimated tax payments that she made throughout the year. So you can see this payments section, that's where you'll want to look for any withholdings or estimated taxes paid. And when we take the withholdings of $9,000 plus the taxes paid of $6,000, that leaves us with $15,000 that she paid into the IRS for taxes. Well, she only owed $82.45, so that leaves us with a total refund of close to $7,000. One of the things we would want to do with this retiree is have a discussion in terms of how can we reduce the refund at the end of the year in order to increase her monthly cash flow throughout the year. So in this case, you've had a couple of options. We could get rid of the $6,000 estimated tax payments, so that way we wouldn't do those anymore. Or we could reduce the withholdings. Now, since these are from Form 1099, it's likely from her Social Security payments or from the investment institution that this would have been taken from. So that's where we would want to make those changes on the W-4 that we talked about earlier. Let's look at a second example. The second example is of a married couple who is still working, And in their case, they didn't have enough withheld in taxes, and so they got a surprise tax bill at the end of the year. So let's look at their tax return. So on their 1040, you can see now there is information on line 1A, that's their earned income. We've also got some information here, 2A to 6A, which is investment income, that would be there. And so that leaves us with a taxable income here of $246. So if we switch to page 2 of their 1040, you'll see after I've taken into account all the credits and deductions, they're left with a total tax of $42,745 for the year. When we compare that to the payments made to the IRS on their behalf, it's about $33,000. And notice that now it shows up on the line for W-2 because that's the withholding from their payroll. So when we compare how much they owed of $42,000 versus how much they paid in of $33,000, that leaves them with a tax bill of close to $10,000. Now, in order to avoid this surprise tax bill for the future years, we'll want to make sure to update their W-4 with their employer to increase their withholding, and that would solve this issue for them. Understanding your tax return and how your tax liability is calculated makes it much easier to decide the appropriate tax withholding. If you need to adjust your tax withholding, you can do so by filing a new W-4 form with your employer, a new W-4V form with Social Security, or by speaking with your financial institution or financial planner to adjust the withholdings on retirement distributions. The tricky part is determining how much of an adjustment to make on your tax withholding. Now, the IRS does provide an online calculator to complete an updated W-4, which is linked in the description below. However, we found it to be clunky and sometimes inaccurate. For our clients, we complete a tax withholding analysis using our tax planning software, and then we provide recommendations on adjusting their withholdings. That way, they don't have to do this themselves. If your advisor does not do this for you, you will need to pay your tax preparer to run a withholding analysis or make adjustments yourself. If you found this information helpful, please give us a thumbs up and subscribe for more financial insights. Thanks for watching, and we'll see you next time.